Welcome back to the Rundown, interview edition. Today, we are talking to Nick Maggiulli. Nick is one of my favorite finance bloggers. He has a great blog called Of Dollars and Data that he's been writing since 2017. He's also written 2 books now. So it was really great chatting with him. We got into a lot of topics today, including why Nick has become bearish on the stock market for the second time ever, what changes he's making to his portfolio, and we also talk about his new book on wealth and the challenges that young people face today when it comes to getting ahead. It was a really fun conversation, and I hope you guys enjoy it. All right, guys, we are talking to Nick Maggiulli today on the show. Nick, he's an author, he's a blogger, he's a data scientist, and he also has a day job. He's a COO of Ritholtz Management. Nick, I'm a big fan of your writing. I've been reading your blog for a long time now. Thank you so much for being on the show today.
Yeah, thanks for having me on. Appreciate it.
Of course. I have so many questions to ask you today, but I want to start here. Your recent blog post from maybe a week or so ago, you talked about how you are now bearish on U.S. stocks for the second time since you've been writing your blog since 2017. The last time you were bearish was November of 2021. So great call, by the way. But now you're bearish again. Can you talk me through and the listeners through your thought process here? And people should really read your whole blog. It's really good. But can you kind of talk me through your thought process and why you're feeling more bearish now for the second time ever?
I mean, it feels like there's a lot of echoes of 2021. Not everything's the same. It's like history, doesn't repeat, but it rhymes. And so there's a lot of that going on right now where like valuations are very high on basically every metric you look at. I like using price to sales. I know it's not a perfect metric. I know margins are higher than they've been. And so I don't think like, oh, this metric has to return to its long-term average. I don't believe that at all. But at the same time, it doesn't, price to sales ratio doesn't sit above 3 for that long. And it's been above 3, just went above 3 once again. And so I'm like, last time it did this, it crashed right after. I'm not saying it's going to crash right away. This could go to 4 or 5. Who knows what could happen, right? But I think it's one of those things where when all the metrics are at the 99th percentile, like you have to say like, okay, either the world's completely changed and this is normal, this is the new average, or like we're probably a little bit inflated, right? And so trust me, I'm a long-term investor. So I'm like thinking, I'm still buying US stocks. I've just made a slight rebalance and I just went from a slightly higher equity allocation. I moved it slightly. I do what Cliff Asness calls sinning a little. So I'm not like sell all your US stocks. I'm not one of those people. I don't think that is it's kind of market timing. And so this is a very, very minor form of market timing, but I'm still buying U.S. stocks just at a slower rate than I was before.
So you're not going full zero hedge or Michael Burry where you swell.
No.
You went from 100% allocation, I believe, to 80-20. Is that correct?
Yeah. So I had 100% wasn't all U.S. stocks. I mean, my 100% was like a diversified equity. It was all risk assets. And now I'm like, okay, let's take that all risk assets down to 80%. And that's only in my retirement accounts, right? So like outside my retirement accounts, I'm not even buying U.S. stocks right now because I'm trying to get a house. And so I'm trying to save for something. So you wouldn't, if you have a goal or a purchase, like you're not supposed to be putting that into stocks. Anything within the next 5 years, like stocks can do anything over a 5-year period. So you really want to save in something that's hopefully the cash is going to be there within, 3 years. I hope I'll be buying a home.
That's awesome. Actually, I want you to settle a debate for me because you said something very interesting where if you're trying to save for something, you shouldn't be putting that into the stock market. You should be kind of putting that into low risk, either a high yield savings account or short-term bonds. If you were saving, this is not for me, it's for a friend. If you were saving for an engagement ring, all right, engagement ring, let's just say you're about a year out, maybe, a year to 18 months out, would you be okay putting that into the stock market? My advice was, you know what? That's okay. Go ahead and put that into the stock market because if the markets rally, you can get yourself a nicer ring. If it doesn't, if it maybe pulls back a little bit, maybe the ring will be a little bit smaller, but you can still get yourself a ring. So
yeah, no.
Debate. Well, what would you say? Where do you fall on that?
This is not really a financial question. This is more of a personal question on how you view, like, how do you view the ring as a person? Like, do you really need to get them a certain type of ring or spend a certain amount of money? I think what you could do is you can say, okay, I'm going to save up to half of it in cash and the other half I'll kind of let it ride. So like, at least I know, like, worst case scenario, I'm getting the ring at the market's not going to go to zero, but let's say the market goes into a 50% drawdown. So I'm getting like 75% of the value of my target value versus, in the case where, market's okay or just flat, then you get the ring you want, right? So I would just probably hedge that if you really care that much. personally, I would just put it in like treasury bills. I wouldn't do anything like that, but to each their own. I get the point. It's kind of fun, actually. Oh,
Yeah.
the market's rallying. I'm going to buy a really nice ring,
That's what I thought. I was like, it's not as like serious as buying a house where you have to like have a certain amount of down payment, so you don't want to take any chances with that. But it's also like you kind of don't want to lose that money either. But you have options. You can get a slightly smaller ring, upgrade it later down. So I thought that was a fun little debate. It actually went on for a couple of hours. So
the correct answer is to do what your partner would want. If your partner's like, why would you risk that and be upset at you for making this decision? Don't do that. If your partner's like, no, we want to make like, just think about what would my partner think about this type of thing and just do that thing. That's probably the better solution than anything I say.
Yeah, that's a good point. I want to talk about, you've written 2 books now on finance. I mean, so you wrote the first one. That was probably exhausting. What got you to write the second one?
So before I wrote Just Keep Buying, which is the first book, I had 2 ideas. Yeah. So thank you for having it. Appreciate that. So that was the first book. I had 2 ideas. The first one became Just Keep Buying. I didn't have a name or a title or any of that. But the other one was The Wealth Ladder, which is my second book. So I knew about that idea. I had written about that in December 2019, and I knew it could be turned into a book. I knew I could expand on a lot of these things. But I was going back and forth with my publisher for my first book, and they were like, do this book first because it seems like an easier book to write if you haven't written a book before. And they were completely right, and I don't regret that decision at all. It was the right decision to kind of go and do the books in the order I did them in. And so, yeah, I put them together, and yeah, it's hard to write a book, but it's much easier when you've been writing online for over 5 years. I've been writing online for 9 years now, but when I first wrote Just Keep Buying, I had all these blog posts and all this stuff. So like I had material, and I had to take it and chop it and mix it up and kind of make a Frankenstein's monster of a much better product than just a blog post, right? And so that's kind of the thing I try to focus on is like, well, I have all this material, so it makes it a lot easier to use that or repurpose it or dig deeper on something and then use it for a book.
Yeah, well, I really liked your first book, Just Keep Buying. What I really liked about it was the way you wrote it. Was like where you had like a summary of each like main topic, and then you gave individual chapters to like dive deep into that topic, which I thought was a really well written way of kind of writing a book. So I really liked how your first book was, and something that you said in the first book that kind of ties into your second book is the way you build wealth over time isn't going to come from savings, despite what my immigrant parents tell me. Like you got to save. That's important. But the way you really do it is by increasing your income. And that I think that advice is great. That's the advice that I was given growing up as well. But do you think that things are a little bit different these days? Because I feel pretty bad for the newer generation. The people that are in college, high school. A lot of our listeners actually, they're kind of dealing with a situation where they're trying to get a job. You see like the numbers for unemployment for new grads is starting to tick higher. That could be because of AI, cost of housing through the roof, cost of, if you want to start a family, the cost of daycare through the roof. What do you say to people, younger people especially, that, hey, you have to still try to keep building your income, and that's not just doing a 9-game parlay on DraftKings or something. You have to actually do it slowly, whether it's through your job or side hustle or whatever. Like, what do you say to young people these days?
I mean, you have to try something. I mean, to say, oh, the system, it's too hard, I'm going to do nothing. I can guarantee what that's going to do for you. That's not going to help whatsoever, right? Or trying to take these lottery ticket bets, or whether you're doing sports betting or all this other stuff. Like we, and of course, like you have 10,000 people do that. One of those people is going to get very lucky and do very well, right? But the point is, like, that is not a viable solution. And so, like, yes, trust me, every generation gets a different deck of cards, right? I graduated in 2012. That was not the best time. It wasn't as bad as 08, 09, but it wasn't great either. That was when housing bottomed. Like, the economy wasn't great then either. It's not, I think it's gotten worse today for younger people, especially with AI and a lot of other things for certain industries in particular. But I think you have to, like, okay, here's the cards I've been dealt. I have to deal with it, right? And so what I'm finding, though, and this is not true of everyone, so I don't want to say this is true of most young people, but, they just came out with, there was some study that was done, and 50% of Gen Z and millennials are getting financial assistance from their parents. And so technically they're not better off than their parents were, but when you include the financial assistance, they are. So some people are listening. It's like, I don't have any of that. My parents can't help me. I'm like, mine couldn't help me either. So I'm not saying that that's the full thing here, but like, you got to do something with what you have. So like, you have a certain, like, I never had financial assistance from parents that other people had. I'm not going to have that for my house. I have to go save my own way there. Right. So like, that's how most people are. That's the default, right? But things are changing. And so, I'm just seeing more data come out that suggests that, yes, the younger people aren't doing as well, but they are getting, on average, they're getting more assistance from the older generation. So that's a piece of this. And then, you got to do what you can with the information you have at the time. So I would say, like, build a skill, like, learn, do something different. Like, you don't have to follow, I think the traditional 9 to 5, 40-year career type stuff is dead. So it's like, what can you do to make money? Let's start thinking about this. Think long term, right? And maybe you have to work a job that's not great just temporarily. And while you do that, what's something else you can do? I was writing for 3 years before I made any money on my blog, right? And so it's like, it takes time, and you have to have that patience to do that. And like, who wants to spend 10 hours a week for 3 years to earn no money? Well, now it's paying off. It makes me more than my income from my job, my actual, 40-hour-a-week job. I have this side business, which makes more. So it's one of those things where, like, I've been very fortunate in that case, but it took me 9 years. Like, can you give me, hey, it took me a long time to get here.
I think that's the thing about, especially with younger people. I mean, when I was younger, I wasn't patient. I was trying to become like the next big thing. When I was growing up, you heard like the stories of the Zuckerbergs and the tech guys that are becoming billionaires at 22. So I was like, I wanted to do that. And then you realize like this is a slow process where like, you're not going to do it overnight. So I have a similar story to you where I just started making videos on the internet, in my spare time after work, in the evenings, and over time that became into a full-time career, which is why I get to talk to you today. So it does take time. I just think with younger people, it's much harder for them because they're just like shown so much stuff on their feeds with the Ferraris and like all the people that are flashing their success on social media. We had that a little bit, but it was mostly like the MTV Cribs where we see it like once or twice a day. Now these people are seeing it 24/7, so it's harder, which is why actually my hot take was that, like, everyone talks about how we should teach high school kids and people in middle school like financial education. I wonder how effective that would be, because like are they going to be like mature enough to like fully understand it and like apply it, or do you just learn that later in life?
I mean, it's better than nothing. It's better than like them getting no exposure to it, right? Of course, like, education matters, but like getting that income is really the thing that makes a difference. But when they finally do get income and start having a higher paying job or whatever, they actually get a job, like, what do I do with that money? How do I manage that is going to be very important for them. But just going back to what you're saying, like, I think the thing is like you have to do what you can with what you have, right? There's no other solution here. There's nothing I'm going to say that's going to change that, right? Like, you have to go and try and figure out something within the realm of like, what are your skills? Like, what are your interests? Like, what will people pay you for, right? Find that intersection, or trying to find some sub intersection in there, and then work on that and go from there.
Yeah, I try to take the optimist angle here, is that like, yes, it's harder these days, but also there's a abundance of opportunity as well with the internet and things like that. You can try to find more opportunities online. So it's tough, but yeah, I think if you look at the positive way, there's more opportunities than ever before. You talked about, building wealth and, once you start making money, what to do with it. That kind of ties into your new book, The Wealth Ladder, where you kind of break down. I really like how you broke down your like net worth into like different buckets. And I think you talked about how, like, I think you're 10,000 to 100,000. It's the grocery freedom, which I really like that, because that's kind of how I see it. This might be kind of, embarrassing to admit, but like, now when I go to the grocery store, I don't really look at prices that much. I know this is like, sounds kind of pretentious, but like, usually I just buy stuff that I need. And yeah, I might buy an extra, bucket of strawberries if it's on sale, but generally I'm not looking at prices. And that's kind of like a great way of looking at wealth. It's like, based on where you are in your wealth ladder, you can kind of just make decisions without having to stress about things, whether it's groceries, restaurants, travel, things like that. Can you talk more about like how you broke that down, and how did you come up with this concept for your new book?
So yeah, the wealth ladder, the idea is you need to change your financial strategy over time. That can mean changing your income decisions, investment decisions, spending decisions, right? And in this case. And so there's 6 wealth levels. I'll just walk through those briefly. And this is total net worth. So like all your assets minus all your liabilities. So level 1's less than $10,000. Level 2 is $10,000 to $100,000. Level 3 is $100,000 to $1 million. Level 4 is $1 million to $10 million. Level 5 is $10 million to $100 million, and finally level 6 is $100 million plus. In terms of the breakdown, you have about 20% of households in level 1, that's less than 10,000. 20% are in level 2, that's 10,000 to 100,000. 40% in the United States are in level 3, that's 100,000 to a million. And these are households, by the way, right? So it's you and if you have a spouse or something. 18% are in level 4, that's 1 to 10 million, and that's actually grown. That cohort's grown more than all the other cohorts. And then the last 2% is, 10 million plus. Let's say 10 million to 100, and then like 100 million plus is like less than 10,000 people. It's like not that many people in the US that are in that bucket. But once you have this framework, you can then think about income decisions differently, spending decisions, etc. And so what you talked about, the grocery freedom, I have this rule called the 0.01% rule, and the idea is take your net worth, multiply by 0.01%, and we're just going to assume that's how much your wealth throws off every day, or that's just a limit you have. And so that amount, if you have to pay for something and that's like the marginal difference in the cost of that thing, you can just not worry about it. In other words, like once you find that limit, just like if the thing you're buying is below that limit, don't worry about it. Just buy the thing, right? And so let's use your example. Let's say you have $100,000 net worth using the 0.01% rule, which is multiply by 0.0001 or divide by 10,000. It's the same way of getting there. That gives you $10. So 100,000 divided by 10,000 is $10, which means on average, we assume your wealth's throwing off about $10 a day. If we assume that's true, which is about 3.7% a year, a pretty conservative return. If we assume that's true, then when you're at the grocery store, it's like, oh, do I get the eggs or the cage-free eggs that are $1 more? Yeah. Like that extra dollar difference, that marginal difference is less than the $10, right? So the idea is by the end of level 2, once you hit about $100,000 in net worth, you can buy whatever you want at the grocery store. Level 3 is 100,000 to a million. That's what I call restaurant freedom. So by the end of level 3, by the time you're at like $1 million in net worth, you can basically buy what you want at a restaurant besides maybe the super expensive bottles of wine, right? So outside of that, you can basically get what you want at a restaurant. Level 4 is what I call travel freedom. That's 1 to 10 million. By the end of level 4, by the time you're in 10 million, you can basically travel how you want. You can get first class upgrades. The only thing you can't really do is fly private. So there are still like carve outs of like flying private. That's really for someone more like 20 million, kind of deeper into level 5 is where we trying to see the data show up there. But either way, I think the idea here is like, as you build wealth, it allows a little bit of lifestyle creep, because right now, most of the finance experts out there will say, no, you can't. No, you can't spend more no matter what. Like, keep your lifestyle the same. And I think, no, you can spend more, but only after you've built wealth. And so that's what this wealth ladder framework does, because as you build wealth over time, it allows a little bit more spending freedom, but it takes, it's only 0.01%. So it's a very slow moving scale.
Yeah, no, I just the way you frame it is so good and so helpful. Especially for the spending. For me, in my household, it's the $20 rule. If something's less than $20, like I don't really think about it. I just end up getting it, whether it's it's a silly Amazon purchase, or if like we're going, shopping and my kid wants something. If it's less than $20, generally I'll be okay just getting it, without having too much fuss about it. But I think that a lot of people have a hard time. Kind of even people that like get to this level of success, like being okay with spending their money, right? I think that's like something that you talked about in your recent blog post, where like people that make money, like lottery winners, end up going bankrupt. There's a very high rate of bankruptcy. Whereas if you like work hard to make money, you sometimes have a hard time spending it. It's something that I deal with my parents all the time. My parents are immigrants, worked really hard for a long time, and without their support, I wouldn't be where I am today. But like they still to this day have a hard time spending the extra cash on something nice for themselves or taking a nice trip, even though they can afford it. How do you get people to like feel okay, especially someone who's been kind of had the opposite way of thinking for so long? How do you get them to kind of break out of that shell and be okay with kind of treating themselves?
Yeah, a lot of it's behavioral and like it's a psychological thing, but these types of rules can help. Like, hey, here's a rule. Try this rule. Okay, try the 4% rule. There's a lot of different things out there. I'm not saying any one of them is perfect or correct, but like throw a bunch of these at them and they can say like, okay, well, if you have a wealth of $5 million and, using the 4% rule, you can spend, $200K a year or whatever it is, right? So it's actually more, I think it's 225, but, or is that right? 25? Yeah, I think it's 225. I can't remember. But it's like you do the math on this thing and it's like, 4% rule on $5 million is $200,000 a year. Like that's how much you should be able to spend. How much are you spending? Oh, $100,000, you can double your spending. And they say, well, I can't do that. I'm like, well, the data says you can, right? That like there's so much research, blah, 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 right? Oh, you don't like that? Try the 0.01% rule. Okay, you can spend $500 a day on whatever you want. Like, and so it's like, I don't know. You got to try to just run those numbers and just see how people react to it. See how they feel about it. Yeah.
It's just because, like, I think for them, for a lot of people, once you've kind of been through some traumatic episodes, whether it was a .com bubble where you kind of, people lost a lot of money, and then you had the financial crisis, and when you kind of go through those hardships, even when you've recovered, it's hard to kind of go back and not feel worried all the time because you've been through some bad stuff. And that's why, like, right now it's so interesting is, like, we haven't had a bad recession since 2008, 2009. I was 16 years old when that happened, so I still remember it. I still kind of remember, like, the vibe. It was a scary time, but I don't really, like, I didn't have to try to get a job through that time. So it's just so interesting how, like, behaviors are different these days from a newer generation of people growing up. I wonder if, like, savings rates and things like that are lower because of that, where people are like, you know what, the economy always just keeps booming. The economy keeps going up, and we're going to be fine.
And there might be some of that going on. I mean, there are periods like I think the Australian economy had I think it was 2 or 3 decades where there was no recessions or anything. So that it does happen. It's very rare that it happens, but it can happen. And so I'm not saying that's what's happening now, but, like, it's hard to know, right? The future's uncertain, and so we have to kind of just do what we can with the information we have. And so, like, I recommend staying diversified because we never know what's going to happen. And right now, stocks are very elevated in the U.S. and maybe that'll come undone. Maybe it won't. Maybe it'll just melt up. Maybe there's going to be hyperinflation. I have no clue. I'm hoping none of those things happen, but we'll wait and see.
I wonder if we've kind of hit an economic cycle now where we, like, know how to deal with economic slowdowns, where we're just gonna, qualitative easing with the Fed coming in. Like, are we ever gonna have another recession? I mean, I'm sure, like, those are some thoughts that people have. Like, are we ever gonna have another recession? Is it gonna be more of like a rolling recession where some industries have it? Like, we're kind of seeing somewhat with the tech industry kind of having, higher levels of layoff compared to others, where, like, the industry that I'm coming from in engineering and construction, like, that's still doing really good, where, like, it's booming. So I wonder if, like, we've just kind of entered a period where, like, you have some downturns in some industries, upticks in other industries, and we just have, like, a rolling recession now moving forward, because it's just, we haven't had anything bad in so long, and it's just making people feel different.
Yeah, I mean, and who knows what's going to happen. But yeah, you're right. Since 2009, I mean, 2022 was the closest we got, but it was mostly tech focused and on valuations. And then ChatGPT came out. Well, usually 11 months into it, and then everything changed. And so now we're kind of all been on the AI train since then.
Yeah, absolutely. Well, I'm going to end with this. So my daughter, she's 6 years old. Are you ever going to write a children's book, Nick? Because I've been waiting to like get a good kids finance book that I can read with my daughter. There's really nothing good out there. When's the Nick Maggiulli kids book coming out?
I have no clue.
Let
me have kids first and see if I can come up with something. We'll leave it at that. I just got married, so give me some time. But
congrats, man.
But yeah, so yeah, I think you need to kind of understand. I mean, I'm not saying I've obviously been around children in my life. I was a child myself, obviously, but like, let me think about it. That's all I'll say.
Well, she has her book fair right now. They do like the book fair at her school, so I'm gonna try to see if I can find your old book and your new book there, because I mean, these kids need to start getting educated earlier and sooner, and hopefully that way they can start making the good decisions now. I just wonder what the next generation is gonna be like, because they're just so they have the ability to like tap a few buttons on their phone and be invested and also make bad decisions as well. We didn't really have that. I used to have to like go to my Scottrade office to like do $5 trades back in the day, and now these kids have like they can tap away and then be like fully invested. So I'm fascinated to see like if they can kind of get set up earlier and be set up for life sooner than like what we were, where we didn't really start having to make financial decisions until I was in my 20s until I really had to start making decisions. Now these kids can start doing it at the age of 16 with custodial accounts,
Yeah. No, it does change the dynamic a bit.
Well, awesome. Nick, thank you so much for hopping on. Again, big fan of your blog. Looking forward to getting your book. I just ordered it recently, so looking forward to reading your new book. Your previous book on my bookshelf. Highly recommend it to anybody. So check out Nick's book, Just Keep Buying, and also your new book, The Wealth Ladder. Should be on Amazon everywhere, I'm assuming.
Amazon, Target, everywhere books are sold.
Fantastic. And if people want to follow your blog, are you still active on Twitter? I mean, where can people follow you?
Twitter at Dollars and Data. I'm on Instagram at Nick Maggiulli, in LinkedIn, and then I'm also, my blogs of dollarsandData.com.
Again, I've been reading your blog for a long time. Highly recommend it to anyone out there, young, old, whoever. By the way, I love your calculators on your blog. I still use those all the time. Like I remember when the Lakers got sold a couple months ago. The first thing I did was I went to your calculator to look up what the sale price of the Lakers was to get the S&P 500 returns. So I love all your little tools. So it's more than just the blog. There's a lot of good tools on there. Highly recommend people checking that out.
Thank you. Appreciate it. And by the way, I answer every DM. So send me a DM on any one of the platforms. Unless it's absolutely unhinged, I answer all of them. So I promise.
All right. Well, awesome. Thanks for that, Nick. And hopefully we'll have you again soon.
Yeah. Thanks. Appreciate it.
Well, all right, guys. Hope you enjoyed that conversation with Nick. Hope you guys have been liking our weekly interview series as well. We got some great guests coming up that I'm really excited to talk to. I'm starting to get comfortable interviewing people, but if you guys have any feedback for me, please let me know in the comments on Spotify or YouTube. And if there's someone that you think we should interview for this show, let us know as well. We've already put a call out to NVIDIA for Jensen to hop on the show. Still haven't heard back yet, but you never know. Thank you guys again for listening and watching. Shout out to Mike and Connor for all the work behind the scenes. We'll see you guys back here tomorrow.